What is up, everybody? Man, I had this like really grand opening today, and it's just really hard to get that out. Everything that's going on in the world, it's one of those things that you just kind of sit back and you think about what's going on around us, and that's really kind of the theme for today's live. Is we're talking about Ann Arbor Metro Detroit real estate, but there's so many things that are going on that are going to affect it one way or the other, whether it's positive or negative, and we're going to get into some of those details here. But let's take a step back. What is going on, everybody? My name is Eric Meldrum. I'm here with my partner and co-host, Mr. Juan. What's happening, Juan?
What is up? That is business partner, by the way. No offense to anybody. Just want to make sure there's some clarity on that.
Let's make that very clear.
Yeah, let's just make it clear. All good. Good evening, everyone. Happy to be here tonight. I know we missed last week. I was out on vacation, but I know you were in great hands. So looking forward to be back. Yeah, and it is a very interesting time, man. It's like every single time you turn the corner, something else is going on. So, I know a lot of you know that. You can feel the pressure. Maybe some of you have anxiety around what's going on too. And just know that like you're not the only one that's feeling that. But that's not what we're talking about today. So I just wanted to, briefly address what's happening in the world, but talk about what you should expect from tonight's live. So if this is your first time joining us, welcome. I'm excited to have you here as well. Both Eric and myself, we serve two metropolitan areas, Metro Detroit, Ann Arbor, of course, here in Michigan as well, and then Tampa, where I reside. However, tonight we are going to be talking numbers. And we are going to get into the nitty gritty about what's happening with the economy and most importantly, what's happening in real estate, because that's our world. That's why you tune in. So that's what you can expect from us. Now, here's what I want to say. I do want to preface this because we are going to be numbers heavy this evening. And for anybody who loves analytics, you're my people, you are going to enjoy this ride. For anybody who may not necessarily love numbers, bear with us. The goal of today is to provide you with resources and information to help you make data-driven decisions, okay? To help eliminate some of that emotional, topsy-turvy that we tend to go through when we have to make big decisions, especially about home buying and the economy right now, y'all. So just be mindful. That's our intent tonight. Here's the thing I want to invite you to do. Be interactive, ask questions. All right. I did this last night in Tampa. We had a ton of questions. All right. And we welcome those questions from you. First of all, we want to know where you're watching from. Right. So what city are you watching from? Where are you watching from in the country? Let us know. All right. Number one. Number two, if you have any questions or something comes up, or if you have something to contribute to the conversation, please, by all means. Eric and I are not economists. We don't play one on television. We're real estate professionals who love numbers, who love understanding what's happening in the market. Because here's what I know. I'm not the oldest man in the world, and I'm not the wisest man in the world, but I've lived through a few cycles now. All right. And what I know is every time a cycle like this happens, what ends up occurring is people make out really, really well. The ones who make really good decisions, and people who make poor decisions get abused. Right? That's basically how it goes. So our goal and intent this evening, like I said, and forgive me for being long-winded about this, is to help you make quality decisions that are data-driven, and hopefully the best and the right choices for you. So that is our goal tonight. That is our intent tonight. We're going to talk about a few specific topics. We're going to talk about what's happening nationally with housing, both the amount of properties that are selling, the interest rates, what's going on there, the payment amounts right now, which are astronomical. I mean, we're going to get into some of this stuff really, really deep. So if that interests you, you are in the right place. If it doesn't, God bless you. We understand. We'll be back to our regular scheduled programming next week, talking about great places to eat and drink and all the things. But for tonight, we're going to talk about what's happening, because this is the time of year, right, Eric, that people start to hunker down, so to speak. They start to think about next year's decisions, right? Or they're in their run, their title run, so to speak, meaning that like, I need to get this done before the end of the year. Okay. And there are people who are in that position. You've got people who own businesses, high income earners, who are having to make a decision about what type of taxes they want to pay next year. And I'm not on here telling you that people are avoiding taxes. What I'm telling you is that some people understand how to use the tax code. And one of those things on the tax code that is a real benefit to most people who are high income earners is real estate. All right. So they're coming into that title run where they know they got to buy something. And I know this is true because I have friends who got a call from their accountant this past week that told them they have to buy something. Right? They're like, you had a good year. And if you don't buy something, you're going to hand that over to Uncle Sam. Okay. All of it. And they're going to pay their taxes. That's not what I'm saying here, y'all. So please understand that. But it would be wise of them to invest that, and they're incentivized through the tax code. So that is one person who has to make that run. The other might be someone who has to relocate for employment, right? Maybe you've lost a family member and you've inherited a home. Okay. Maybe because of divorce or illness, you have to sell your home. Well, our goal tonight is to share with you information that can help you make qualified decisions, whether now is the right time and how to approach that. So that is the intent. That is the big promise that we're making. We're going to deliver that to you guys this evening. Again, we'd love to know where you're watching from. Feel free to contribute to the conversation because we are wide open in that respect. So with that, Eric, let's kick the doors open here, my man. Where do you want to start? It's up to you. I'm going to let you point the ship tonight, so to speak.
Yeah, so let's dive into some numbers. I mean, I think we want to start locally here. We got a lot of people tuning in locally, and if you're looking at making a move to Michigan, these are things that you're going to have to get acclimated with as well. So we're going to start with some of the local MLS data, and then we'll zoom out kind of nationally, what's happening around that's kind of influencing this, from a broader view. But one of the things I always love doing on these is like getting in because that. This is the back end of our MLS, right? When we look at data across a multitude of platforms, you can go on any online portal. Some good ones, Redfin, Realtor.com, have some great information. But this is real time. These numbers, and there's no ambiguity about this. This is the thing about transparency is like I'm showing you inside the MLS, so we can't say the data isn't accurate, or have an opinion about it. So I love showing this because it's user friendly and it can tell a big story about what's going on in the market. So taking a look across 3 different counties, here you'll see Oakland County, Washtenaw County, and Livingston County at the top. These are the major markets, here in Metro Detroit and the Southeast Michigan area. There's some other ones too. Macomb County is in there, but that's a little bit outside of our zone, that we punch in every day. So we're going to focus on these. But the big thing I want to, draw everyone's attention to, we're going through this. We're going to be looking at new listings coming to market. So these are really leading indicators of how many people are actually selling on a month by month basis. All right. I'm going to come over here to this. And this is the entire MLS. Okay. So this blue line here is the entire MLS. And then you have Oakland, Washtenaw, Livingston in the colors, down below here. But the entire MLS we saw from 2020, March 2020, this is where we started seeing this down curve. Okay. So the entire MLS had 189,000 listings come to market in 2020. Now we started in what we all know is the pandemic. We started getting low inventory. And now fast forward, we had a little spike, back in the springtime of 2021. And then we started seeing steady listings come to market, right? Through 2022, kind of really remained the same. And then at the start of 2023, we started seeing a down curve. So normally you would see some seasonality here, in the October, November, December, January timeframe. Because let's face it, who wants to move in the wintertime, right? Nobody really wants to move in the winter. So normal seasonality is built in, but we started seeing this come back down below pandemic levels. Okay, so this is a clear indicator right here. When we look at the new listings getting below pandemic levels, that's where we start really paying attention. Okay, really what's going on there. Okay, so meanwhile, we have very low inventory. I want to go over to homes for sale. Okay, so we can see this is a clear indication as well. Kind of follows the same curvature, right? So the entire MLS, started coming down, and now we're down to 18,250 homes, for sale as of September, okay, end of September. So that's down 5.2% from the previous year. Okay. In some of the more popular counties like Oakland County, listings are down 14%. Washtenaw County is down nearly 7%, and Livingston County is down nearly 4%. Okay. So in a market like Livingston County, where on average there's 400 to 600 homes for sale, being below 400, that's a big deal. All right. There's not a lot of inventory. So when we look at homes for sale on the market, we start asking ourselves, like, okay, what's going on? Is it still competitive? Are people still offering above asking price? I mean, these are the questions that we're getting, on a daily basis. And it's a valid question. This is coming into interest rates that are 8%. Buyers now are asking, what do I do? Right? If I want that house and I'm paying 8%, how do I even approach those sellers? How do I approach that multiple offer situation? Because I don't want to get in a situation where if prices do come down, right, which we'll talk about here in a little bit, if prices do come down, I don't want to be left holding the bag, on this. Well, I don't want to be underwater on a home. Everyone has the PTSD from the '08 crash.
Yep.
Homes are underwater. People are foreclosing on homes and they have to give them up. They basically just handed the keys back to the bank, right? And we've had a lot of chatter. There's a lot of headlines, a lot of if it bleeds, it leads type headlines out there saying like, yes, there's a crash coming. All right, we'll share some data, let you guys make the decision whether you think that's happening here in a little bit. But the big question is for buyers right now is, how do we approach the market? So one of the things we love doing is coming in and looking at these numbers here. So we look at percentage of list price. Okay, we'll come in and take a look at the average close price to list price, and as they crunch the numbers here, wait for them to get caught up. This is a really good indication of how many homes are going above asking or below asking. Is it more kosher for that to happen, in this market or that market? And you can see back in 18, this is a 5-year span. So we were below 100%, right? Up until, you guessed it, right, 2021, when things just got absolutely bonkers, right? And this was not a normal time in the market, right? This is what actually, I think, set us into one of the worst real estate markets I've ever seen. Was these extremely low interest rates, and everybody was going and getting a 2% or a 3% interest rate, which just threw things totally to the wind, right? So this was not normal. Okay, so things started going absolutely bonkers over here. Over 100%. Washtenaw County, it was 102%. Livingston was 101 as we get into it. And now we're floating right back around this 100% level. Okay, so things are still competitive. What this is telling us, things are really still competitive in this market. So that's a good indication. I wanted to look at some stats from last month too. And this is really, really telling, in terms of the market. This is the greater metropolitan area, which covers, Metro Detroit, Wayne County, Oakland County, Livingston County, Washtenaw County, all the major counties here. And when we look at that, we throw Detroit in here and they really skew the numbers. So I always, when we look at the other, let me pull up this. There we go. Hold on. Oops, user error. Hold on 1 second. Get this back.
Live TV.
There we go. All right. So I was talking about this chart. You guys weren't seeing it, but these numbers are from September 2023. So new listings came to market down 11% from year over year. Pending sales were down 7.5%. Closed homes were down 20%, and days on market are down 7% as well. So here's where things start getting a little bit interesting, is when we start talking about price. So all these numbers are trending downward, and then we look at price, everything's trending up, right? Median home sales are up 6.6%. Average sales price is up 6.1%. Now, in a market where new listings are down, pending sales are down, closed sales are down, one would just immediately assume like nobody's buying homes, right? Nobody's buying homes, but that's the complete opposite, which is why we want to talk about this, because as Juan had mentioned in the beginning, like people are still moving, right? People have moved for various reasons, whether it's death, divorce, illness, you inherited a property, maybe you have that big tax bill coming up, and somebody's still got to sell, right? Somebody still wants to buy. So these things are happening every single day. When we look at the amount of closed properties, and yes, it's down 20%, but 3,226 people still transacted in the month of September in Southeast Michigan, right? 3,000. So we can look at these numbers and say there's a crash coming, but people are still buying, right? So that's the big thing I want to point out here. Percentage to list price ratio, like I said, 100.2%. That's up 1.2% from the previous year. So this is an indication to me. We look back at a couple other months, it was right at 100% as well. So people are still at averaging at list or above list offers on homes. So it's really indicative. And I just want to take a pause here and really kind of zoom out, because again, these things are happening every day, and we tend to get a little bit close to them. So I always like to take a step back and really kind of understand what is driving some of this, right? So when we look at these numbers, the big thing that I draw from this is, yes, inventory is down, but people are still transacting, and that's consuming all the inventory that's in the market. So when you eat up the inventory and there is no inventory to sell, well, the homes that come on the market, they're going to be desirable.
Yep.
Right. So more people are going to make offers on those, and we're still seeing multiple offer situations. Now, is it like 2021 where it's $40,000, $50,000, $60,000 over asking? No, it's not. Maybe 5, 10, 15K if it gets really competitive, turnkey. But more importantly for sellers, when you're selling, buyers are expecting these homes to be very turnkey. Right? That's the one thing we talked about this last week on the live. No longer can you get away with, not replacing that furnace, or having an aged roof. That's going to reflect, in what you're going to get and the type of offers you're going to get on the property. If you still want the price that the online portals say your home is worth, always consult your real estate professional. Give us a call. We'll give you an honest opinion of what your home is going to sell for, because these prices are going a little bit wonky, right? And if you're trying to get what your home said it was worth last year, it's not the same market, right? And if you didn't do those repairs or updates, then we're going to have to take a look at a different pricing strategy to get your home to sell for over asking or get more value out of it. Right. So that's the big thing.
Yeah. It's pretty important that we discuss local level numbers. So here's the thing. I want to tell a story with this, right? Like, it's very easy to get overwhelmed with data. This chart's even really hard to see, right? I'm looking at the same thing you guys are online right now. I know this isn't the easiest thing in the world to look at. So bear with us. We know that that's the case, right? But we're going to share some things that are going to be helpful. And if you walk with me, I'm going to help tell a story. And why I'm going to do that is because if I tell a story through numbers, what I have found in my life is it really helps me make informed decisions, right? I can kind of see where things are going. So that is the focus, right? Like, here's what Eric and I want you to know. No one knows what is going to happen next. No one, not us, not even Warren Buffett, right? But you can, by studying history and looking at trends, be able to take a snapshot of where you believe things are going. And Wayne Gretzky, who is one of the greatest hockey players of all time, shout out to Original Six teams, and being a huge hockey fan as a child growing up. When they asked Wayne how he was so much better than everybody else, what was the difference? And he just said it very simply. He said, I don't skate to where the puck is. I skate to where the puck is going. Okay. And that is what we're going to help you do here, is skate to where the puck is going. Are there external circumstances that none of us can control that could possibly change the direction immediately overnight? 100%. You guys saw it. But look, historically speaking, 08 only happened one time. People have been living in houses and buying and selling real estate for a very long time. Back when they were trading stones for caves, right? Like, listen, y'all, like this is how it works. But that event only happened once. You cannot let a one-time event change everything about how you think through things, right? Because there are anomalies, all right? But we should learn lessons from it. Not going to sit here and be naive, but let's walk through this and tell a story. So the very first thing that I want to talk about right now is because there was an article that came out recently by the Wall Street Journal talking about that how foreclosures were up 116% and that we really need to be watching what's going on here. And I'm not going to hit you with this chart, but here's what I want you to understand. Historically speaking, we have somewhere between 230,000 and 300,000 foreclosures every single year. The last 3 years in the United States, that number has been under 50,000 a year. And it's been artificially depressed, right? People were able to put their home in forbearance. They were able to work programs, and we have the numbers on that, y'all. And I'm not going to beat you up with those numbers. I have them tonight. And we're going to put the link to where you can go look at this stuff yourself. The goal here is not to gatekeep. Okay. But I want to share this stuff with you. The first thing I want you to understand is why. Why is the market acting the way it is? Because anytime that interest rates go up, the first thing that we would think as a rational human being, right? If I can't access money, then what sellers are going to have to do is lower their prices. Rationally, that makes a ton of sense. And that's what should be happening now. Correct me if I'm wrong, Eric?
Should.
But it's not happening. And the reason it's not happening is because homeowners have beautiful mortgages right now. And when I say beautiful, I'm talking about incredibly beautiful mortgages. And I'm going to show you how gorgeous here in 1 second.
When I saw what you're about to see, guys, like this paints a completely different perspective on what we're talking about. Like your jaw is going to hit the floor. Be like, oh, I get it. I understand now.
So here's what I want you to do. I want you guys to see what we're seeing. These are the numbers. And these numbers come from a company named Black Knight. And I'm sharing this with you. Black Knight is a giant data aggregator that companies like Blackstone and State Street and Vanguard, they use this company and their data to make decisions. The same kind of decisions we're talking to you guys about potentially making. Okay. And what you're looking at right now, and I know this is noisy, but I'm going to simplify this really quick. This is active mortgages by interest rate and vintage, meaning what year. If you look at the top up there, you'll see it. Pre 2010 is that light gray. 2010 to 2014 is the little bit darker gray. When you get into the blue, you're 2015 to 2017. If you get into the little green there, you're 2018 and 2019. When you get into the light green and the darker green, that's all 2021, 2022. Think of that as COVID. And the gold is 2023. That's the current year you're in. Why are we looking at this chart, Juan? Well, that's a great question. And the reason why home prices are not going down when interest rates are sky high, okay, is because of this chart right here. And here's what I want you to take a look at. All right, I'm going to go through this together as a team, y'all. This number's here. Look at the amount of mortgages that are at 3.875% or below. And that one that is poking all the way to the end of the page is 2.875%. And if you're wondering why home prices are not coming down, it's because these people, God bless them, are not willing to exchange what they have, that 2.875 or 2.5 down there, right? This is 60% of all the mortgages. Guys, I want you to look at this chart. If it was turned on its side, it would look like a giant mountain. That would be Mount Everest, that 2.875, compared to all of the other mortgages. Remember, this is active mortgages, meaning all of the mortgages. Over 60% of every mortgage in this country is at 4% or below. And I know we shared this before. When you see this chart, it feels different, right? These
This is the jaw hit the floor moment. Like this, when I saw this, like I already knew this, but seeing this data just like it puts it into perspective. Right, seeing this chart and actually visualizing how many homeowners have a rate below 4%, it's absolutely mind blowing.
it's
Right.
it's
And people are wondering, well, and you're probably actually in this boat. Like if you're watching this and you're in a below 4 interest rate, the question that you're asking yourself is if you need to move or want to move, right? There's a get to and want to, type approach to moving. If you get to and want to, how do you make that happen? Right? How do you make heads or tails of giving up your 4% interest rate to go get into an 8% interest rate? Right? How does that make sense for some people?
Yep.
And we'll get into that in a little bit. But the short answer is sometimes it just doesn't. Sometimes it just doesn't make sense. Other ways, there's other creative ways to do that. But the interest rate, what did you say, Juan? 8% before we hopped on? Just to close
8%
that?
today. Yeah. So I'm gonna share this in a second. I want to share this with you guys, right? Like, because you hear this and you're like, no one's gonna move, right? You hear that, right? Well, Juan, the guy you're looking at right now just bought his house 2 Wednesdays ago at 7.125. And trust me, it hurts. I would love to have had a 2.75% mortgage, but guess what? That's not an option for me. And I got to purchase my home, right? I get to. I didn't have to. I got to purchase it. I feel blessed to be able to do it. I didn't take a bad mortgage. I have a fixed rate mortgage. I have a ton of equity in this house, believe it or not. That's a whole nother conversation. But regardless of that, I own a piece of real estate. It's mine. I have control over it. Even if the market goes down, guess what? I'm going to be paying housing costs either way. I might as well be paying housing costs for the thing that I'm in. And here's what I know. Over time, real estate proves itself. If I'm here for a decade, I'm going to make out like a bandit. All right. Now, here's the thing we were talking about. So we asked the question, why aren't prices going down dramatically? Why aren't they crashing if interest rates are so high? Well, this is the answer. They have what's called the lock-in effect. They're locked in. And I want to share this next tab with you. I have to share this with you guys. I saw this in a Facebook post and I went and it's from the National Association of Realtors. And I think that this is a wonderful chart. You don't need to get in the weeds like we just did with all those numbers. Here's the thing I want you to know. This is a representation of active listings in the United States. So when everybody's sitting around here going, this is going to be like 2008, let me assure you something. Could the real estate market completely change? 100%, but it is not going to look anything like 2008. Look at how low the listing inventory is right now. Okay. This dotted line that you see running across here, this dotted line here, that's the mean. That's the average. Historically speaking, all the way back to 94, 2.2 million homes listed. That's the average. We're just at like 1.2. There are no homes. There are not enough homes on the market to flood the market to drive prices down. So going back to our other chart and looking at why, right? People have 60% of the market has mortgage rates under 4%. So in order for us to have a flood of foreclosures, we're going to have at least 2 external factors come into play. Eric, can you tell me what you think those are? Share with the audience. And if you're watching, let us know what you think it is, right? Share with. But there are 2 that we absolutely have to have happen in order for there to be a quote unquote wave of foreclosures. Okay. So what would one of those be, Eric?
Yeah, well, if we're going to see the foreclosures like we did in 08, like there has to be some bad lending practice that is hiding that nobody knows about, and the likelihood of that, I'm not sure. But
Right.
in order for us to have foreclosures, to the rate of that, people have to be underwater on their home. They have to be able to not afford the payment, and I don't know that enough people have bought recently that are going to see that effect. If they do walk away from their keys. The other thing is there needs to be massive layoffs. in the economy, right?
Yep.
There needs to be a huge layoff wave, and that needs to be extended for a long period of time.
Yeah. So you hit on the one thing and you just drilled the other. So in order for us to have, based upon what the data is in front of us, right? In order for us to have a wave of foreclosures, the two biggest things that we would need in order to see that is we need people to be out of work, period. Eric's on that point, and it's going to take a little while. And the reason it's going to take a little while is because all of these people that have these low mortgage rates, they also have small payments, y'all. And a lot of them have equity. There's over $40 trillion in equity in U.S. homes right now. It's not about being underwater. That's the little thing that always hangs people up. Well, I'm upside down. Doesn't matter the upside down. Are you going to trade a $2,200 mortgage on a 4-bedroom, 2-bath house to go rent an $1,800 or a $2,000 apartment because because you're upside down in equity? You're not going to do that as long as you have your job, right? You're not going anywhere.
The other thing that's not going to happen is even if your house, goes below the bank's perceived equity on your loan, trust me, I don't foresee any banks coming and knocking on your door saying, "Oh, Mr. or Mr. Homeowner, your house, we just valued your house at 190, and you really owe us 200, so you owe us $10,000." Like that scenario is never going to happen. Banks have bigger things to worry about right now.
That's not how it works. So again, in order for all of this inventory to come rushing to the market, a wave of foreclosures, people have to start losing their jobs like crazy. And I don't know if you've been watching the economy at all. The jobs numbers keep coming in strong. Now, you can read the data. Listen, I'm a data nerd. I look deeper than that. I understand it. But the point of what I'm saying here is people are still having their jobs. They're not losing their jobs yet. The Federal Reserve's trying to make people lose their jobs, and they're not. Right. So that's not going to help the situation, and you need it to make this situation better. The other thing is you need this chart to be inverted. I'm sorry that I'm stuck here, but you need it to be inverted. People are like, these numbers are crazy. I can't believe people are affording it. Look at how small the amount of mortgages that are actually taking place right now. And in order for there to be a giant wave, you would need this to be inverted. You would need more interest rates up in the 8s and the 7s and the 6s, and people losing their jobs than you have currently. Okay, so I realize I'm passionate about this, but y'all, don't be fooled by headlines. Foreclosures are up 166%, but when you go from 1 to 3, yeah, that number looks pretty dramatic, right? It's not like we went from 100,000 to 400,000. That is not what is happening in this marketplace. Be mindful of it. We're getting back to some normalcy in the government making people pay their bills. They're no longer bailing people out. All right. So keep that in mind. All right. Now I'm getting in the weeds here, but we talked about this foreclosure number that came out. We talked about active inventory, right? So again, showing you here that peak is 2008. Let me get this out of the way. That peak is 2008. 4 million homes were listed on the market in 2008. No one was buying, just like no one is buying today. And that is what's got everybody saying the things that they're saying. They are making a correlation between the peak of 2008 and the amount of homes that were listed and 2023 because no one is buying. That correlation is correct. The big gap in between is the amount of homes that are actually available to purchase. Y'all, we're not getting any relief unless, again, some major external factor comes into play. Builders aren't building homes right now. The money that they used to borrow to build is drying up. That's not good. We need them to keep building homes. We talked about this like almost 6 months ago. We said, if this keeps on, they're going to stop building homes and it's going to get worse, not better.
Yeah. And, it's really, I don't want to say funny, that we're talking about new construction because new construction does have one of the best interest rates right now. Builders are putting out incentives, right? They're offering concessions. They're offering low interest rates with their in-house, lending teams. They're trying to make it work. They're trying to make the numbers work. So I will give it to the builders, that are still pumping homes out. They're trying to to turn the inventory, but they're being cognizant of the fact that, yes, their inventory is not getting consumed as much, which puts pressure on the balance sheet, right? They're holding a lot of liabilities, right? They have workers that are standing by. And this is the same thing that happened in '08. And we never fully recovered from it. When building stopped, builders basically laid off all of their trades, right? So the high skilled labor trades, those people ended up opening up their own businesses, or the bigger companies retained the best tradespeople, right? And a lot of the other ones just kind of fell by the wayside, went into another industry, and just got out of the trades altogether. Since then, in 2008, there has not been an influx of new builders or tradespeople into the market, right? Into the industry, right? So the average age of a builder 20 years ago used to be between 30 and 45 years old. The average age of a builder now is right around 50 to 75 years old. Okay, so I don't want to, like, I hate going down these paths, but if you look at history and look at what's happening, right? We know that the builders are under a lot of pressure, from a balance sheet liability perspective. There's nobody behind them, right? The decades following, who is going to build, right? Who is going to build homes if nobody wants to get into the trades, if there's no new builders that are stepping into that industry, right? And this is the type of stuff that, I'm looking at on a day in and day out basis, and just asking, like, okay, yeah, we might see a crash, but even if we don't, we still have a housing shortage problem, right? And if nobody's going to be around to build homes in the next 10 to 20 to 30 years, how is that going to get any better?
Yep.
Are we just going to live in high-rise apartment complexes? Is that the next thing that's going to come? Like, the only companies that can build something are multifamily, and that's what our economy is turning into, is just a rental economy, because nobody's willing to build homes.
Yep. So Eric, I want to start with this, okay? Because again, foreclosures, this wave, where's this inventory going to come from? Wall Street Journal headlines: foreclosures are up 150%. Well, let's talk about the numbers. Okay, let's talk about the numbers. This is August of 23. Okay, sales data is always a month behind, y'all. Okay, so when the next month comes out, I'll make sure that you guys see that too. But here's what I want you to wrap your mind around: August of 23, delinquencies, foreclosure starts, that is up. So that is a leading indicator, like we were talking about before, right? A leading indicator. Serious delinquencies, 90 plus days in foreclosure, that number is up 1.25% in August, but it is down 3.3%. And look at the year over year. People who are 3 months behind in their mortgage or more, that number is down 21% year over year. That, just take a step back and think about that. New originations, which means new mortgages being filed, down 26%. People aren't buying homes. That's a fact. Right? They're not applying for mortgages. It is, right? Almost a third.
20, yeah.
Yeah, almost a third less. Foreclosure starts. Now, here's the thing we wanted to talk about. This means the process is beginning. Now, here's what I want you guys to understand. You are in pre-foreclosure on day 2 of you not paying your mortgage. Most people do not recognize that. Your mortgage is due on the 1st of the month, no matter where you live. On day 2, if they have not received payment, you go into pre-foreclosure. If you go over to Zillow, and I don't know if they still have that feature anymore, Eric, but they used to have that where, like, you would see the pre-foreclosure. Literally, you didn't pay 5 days ago and they could report it, right? So there's a behind the scene things you need to understand. But foreclosure starts, this number is up. Okay, now it's giving you the total representation. They didn't give you a percentage number here. They gave you a start. Okay, now keep in mind, most homeowners in this market have equity in their properties. They can either they can get current on their payments, or they can sell these homes and make money and pay the bank and not go into foreclosure. FY. Depends on where you live in the country. All the processes are different. In the state of Michigan, you have a 6-month redemption period once they foreclose on your property. FYI, before you have to get out. It's crazy. right? So it's 3 months at least before they can go see a judge. Then they can sell your home at foreclosure, but you have the legal right in the state of Michigan to pay off what you owe and a penalty and a small fee to the person who bought your mortgage back, which in this case would most likely be the bank, to keep that house up to 9 months. All right. So keep that in perspective. So again, you start looking for these waves. When? Right? If this wave of foreclosures was to occur in the state of Michigan, y'all would be waiting till next Christmas to start buying those houses. Just want to make sure everybody's on the same page because this is how the process works. All right. Now, foreclosure starts 31,000. Monthly change up 21.9%. That's a big jump. It's paying attention, right? Year to date change, it's still down 1.85% year over year, but how is it trending? So this is the line we want to start watching over the next few months, y'all. Okay. So I'm just giving you some perspective. Now let's back out a little bit and take a look at this. You can see it coming across the board because now you're going to see a little bit of the chart, right? Like now you can get a handle on what it actually looks like. New originations, meaning that's new loan applications on properties that have been under contract. They're opening up a contract on that. Okay. And then total delinquencies is what we were talking about. So in August of 2022 is 3.2%. In August of 2021, 3.175 or 3.17. So that now you see that decline there, right? It was higher November, December, and January and February last year. Or I'm sorry, last year and this year. It went down dramatically in March and then started going back up again. So this is something to pay attention to. It's not a giant alarm bell that everybody needs to lose their mind about. It's just a headline, right? Until it becomes a trend or a pattern, there's not really a whole lot that means a whole hill of beans in there. Okay. Now here's what's going on here. We talked about this briefly, and I want you guys to see this. Today's the first day. So last year, I believe it was October 29th or 23rd last year, mortgage rates hit 7.24%, I think. And that's when the market like totally tanked. People were not buying last year, right? Eric, November and December were so slow. People were just not moving. They weren't going anywhere. They were like, oh, we're all set with this. Interest rates went from 3.25% to 7% in like less than a year.
It was a combination of interest rates and just fatigue, because last summer we had really aggressive, offers going on. There was still a lot of pent up demand, a lot of competition, people who were, thinking they missed the boat, on the 3 to 4% when it was like 5.5 and they started seeing it, creep up. They're like, crap, I better get back in the market. Right. I'm just going to pull the trigger and do it. And those are some of the best decisions, like, we look back on this historical moment, when somebody always says like, when's the best time to buy a house? The best time to buy a house was 2020 and 2021. All right. That is the best time that if anybody bought at that time, they will tell you that they fought tooth and nail to get that home. They overpaid for it in their perceived value of the home, but now they're sitting on $100, $120, $150,000 worth of equity because that home has gone up so much since then.
Yep.
So looking back in November, December of 2022, you just know like this wave was coming off. Everyone's fatigued. Like, I'm not dealing with the multiple offers. I'm not doing this. Oh, but the interest rate went up. Oh, forget it. Like, we're out. We're not doing anything.
Yep. So that happened. Here it is. October 20th of 2022 was a Thursday, 7.37%. And that was the highest number we had seen in like 20 years. Right. So people lost their minds. They were like, we're not buying houses. They started slowing down. And then we had this big drop off. And I remember it was like November 9th. Look at that. It dropped back down to 6.62, which is good. At 3/4 of a point is a lot. Right. And then it dipped back down during the winter. This is when we started to get busy again. February. And Eric and I can attest to this. It was the second week of January when our phones, it was January 10th. I've told this story many times. January 10th, my phone started lighting up here, right? The call started coming in, and look, January 9th, rates went down to 6.14%, and then they dipped down almost 6%. February was a rocket ship. March got it cranking down, and we went through the summer, did what we did. Now here we are at 8% today, all right? Listen, y'all, it doesn't feel good. It's not nice. It's not pretty. But here's the thing about buying a home. You're not buying an interest rate. Okay. You're using interest as leverage. You're buying a home. And I want to take a second to focus on this. The best time to buy a home is when the time is right for you. Doesn't matter what the interest rate is. And here's what I'll say. Y'all, I don't know what's going to happen. No one knows what's going to happen with interest rates. But if things stay stable, they're not going anywhere. The Federal Reserve is not going to go down on interest rates if everything stays status quo, because inflation has gone up for 2 months in a row. Jobs are still going up. And his goal is 2% inflation. We're creeping back up to 4. So it looks like they might hold, but that doesn't mean that interest rates are going to go down. It most likely means they're going to stay steady. So we're going to be in this high interest rate environment, whatever the number is, for the foreseeable future. Here's where interest rates would most likely go down. If whatever we're doing in the Middle East right now turns into an actual war, that we have soldiers, boots on the ground, that type of activity, the United States government is going to go to the Federal Reserve and say, we need money for bombs and tanks. And the only way for that to happen is for the Federal Reserve to say, you know what, we'll buy your U.S. Treasury bonds, but we got to print money to make that happen. And in order to print money, because they don't print it anymore, the Federal Reserve just walks over the computer, types it up, says, here you go. Here's however many billions we want to loan you. And to do that, they turn the dial down. And if they turn the interest rate dial down in an environment where we do not have any houses to purchase, what do you think is going to happen to the average home price then? Supply and demand, y'all. We already have more buyers than we do available houses. Now, we do not have buyers who can afford the houses, but if interest rates come down, all of a sudden they can afford the houses. That's how we got into this situation. So I'm sharing this with you. I don't know that that's the future, but what I do see, and reading the tea leaves here, is that this market is going to be in this kind of like weird stagflation environment for the foreseeable future without some kind of outside influence. And if interest rates start to go down and people do not lose their jobs, home prices are not going down, they're going up.
Yeah. There needs to be catastrophic, events to happen to really tank the housing market. And at that point, like, if we're looking at the macroeconomics, it's not even a housing market issue. It's a global, currency, monetary, diplomatic, type issue that's going on, and that we're all just in effect of it.
Yep.
So I don't believe that the housing market alone, can take a dive, with interest rates. And, the devil's advocate on all this stuff, because I always love, kind of scenario playing, with our clients, because these are the conversations that we're having on a daily basis. Some of the common questions, that we get when, people reach out to us, about, hey, I'm thinking about moving to Tampa, or I'm thinking about moving to, Ann Arbor. What's the market there, like? Is there any opportunity to pick up, homes under asking? I mean, our sellers, looking to negotiate? How long have they been on market? And, here's the reality of it is, if interest rates do come down, all right, so fast forward to some time period in the future, and the Fed's got their crap together, things are stable, and they say, you know what, we're going to hit the decline button on this, and we're going to bring those rates back down. All right, what is going to happen? What is the likely scenario that is going to happen when rates do come back down? Okay. Yep. We're likely going to see all of the buyers who said 8% is too aggressive for me. I can no longer afford what I'm willing to buy. They are going to re-enter the market. All right, we have to remember that. What was the headline? I don't even know if the stat is true. Fact check us on this. But I think one of the headline was 99% of home buyers have now declared some sort of unaffordability in the market. Right? Whether that's unaffordable for what they want, or just said, you know what, these interest rates are too high. There's still homes out there, for $200,000, $300,000 where, they are manageable payments, for most people. But again, they're not the homes that you want. they're not the homes that you might want, or there's not the homes that you might want in those areas. Yeah. Yeah. This is a good one. Home buyers must now earn $115,000 to afford the typical home in the U.S.
Yep. And the stat that you were searching for, Eric, is 99% of U.S. counties are unaffordable for the average American. They cannot buy a home in 99% of the counties in the United States based upon income and interest rates right now. So he's spot on with that.
And we ran the math before. I mean, we pull up the mortgage calculator, here, and you start running the math. We did a couple episodes, on the channel here about, what it actually costs to buy a home. And when you start looking at, your housing cost is supposed to be 28%, no more than 28% of your gross income, coming in. We start looking at the average home here. I mean, $3,000 a month. Let me just run the math here. We got, just call it 3,100 divided by 0.68.
It's $38,000 a month or a year, right? After taxes.
Yep.
While Eric's
doing to afford this payment, you need to be bringing in what the mortgage company says is around 28%. So you got to be bringing in around $11,000 a month.
Yep.
All right. And if we up that, because they will let you go to 46% DTI, debt to income ratio. I'm just going to use that one. So 31 divided by 0.45. So let's call it $7,000, right? You got to be bringing in $7,000, a month, which comes out to $82,000 a year.
Right. But think about that, y'all. Like take a moment to think about that. $7,000. Who wants a $3,100 mortgage payment when they make $7,000 a month? And that's gross. They'll let you do that gross, which is gross, by the way, different kind of gross.
It is
right?
Gross. You're right.
They'll let you do that gross because it doesn't take into we were talking about this. I just bought a new car. Trust me, I did not want to buy a new car. Our lease was up. I had to make a decision, and we have a large family. We don't get to have just one car. We have a small car. I have a 2013 very sexy pewter gray Volkswagen Passat, which works good for one of us, but I'm in real estate. I'm out with clients all day. I have a wife and 3 kids. They have to go to school. We need another automobile, right? Lease is up. I don't mind driving a car that could break down at any day, but I'm not going to put my wife in it. So we need to get a new car. It was terrifying. And the point why I'm bringing this up is because I started looking at potentially buying out our lease because I thought that was going to be a good play. And with used interest rates somewhere between 10 and 14% on average, that became very unrealistic very quickly. They were talking about $1,100, $1,200 a month. We went and looked at new leases, $1,200 a month. I'm like, that is more than I pay, right? For my last house, right? Like I'm not doing that. It's never going to happen. And you look at these statistics. So I'll share this with you. This is from bankrate.com. And this is the most recent statistic for new car payments. So we're just sharing this with you because you got to put all this together. The average monthly car payment for new cars is now $729. So think of it this way. If you had to get a mortgage, right? A mortgage on a house that's $420,000, because that's what we were going off of based upon what that article said. The average home payment is $420,000. The median home price in the United States is $420,000. So $420,000, and you had to get a new car. You're already at $4,000 a month post-tax income before you turn the lights on, put insurance on have insurance on the car, put groceries on your table, and done anything else with your life. So I know this sounds very gloom and doom, but we're sharing this with you because when we share this information, we always love to do the math, right? So that's why they're saying that you have to now make $115,000 a month in order to buy the average home in the United States. So lots going on here, right? We've been going tangent here on these numbers, but the reason we're sharing this with you is because even with all that said, there are still people who are buying and selling in this country every single day. We have people who are buying and selling in Michigan every single day. We helped a veteran family close on a home yesterday. It was a 6-year journey for them, y'all. 6 years. We worked with that family to help them find a home. They've had all kinds of things get in their way in life. But you know what? They were able to take possession, get the keys, nothing but smiles. They did not care about their interest rate yesterday. They're well within their payment abilities. And now they get to put a roof over their head and raise their kids in an area they feel good about, in good schools, and spend the rest of their days in their forever home. And we're forever grateful to be able to serve families like that and people like that. So
it's
listen,
all about.
Still happening every single day, right? It's just not happening nearly as much. Like we said, we're transparent with y'all, right? 30%, the numbers do not lie. And that 30% is down from last year. And we told you all last year, there was less houses being sold last year, right? So this is the environment that we live in right now. And we hope that our shares today helped you guys. We'll put the links to this information. That mortgage monitor, if you're a numbers nerd like me, man, it is a great place to live, because you can not only see where the puck is going, you can see 4 ice rinks ahead. It's wonderful in that respect, right? Like giving you really good perspective. Like I said, if it's good enough for BlackRock, Vanguard, and State Street, that's probably data that I'm with, feeling very comfortable in looking at. Also, we have experience, so that helps too. If you guys are considering making a move, right, to the greater Detroit area, Ann Arbor, heck, anywhere in Michigan, we got your back. Do not hesitate to reach out. And if you're thinking about picking up that vacation home, second home, whatever it is down here in Florida, holler at your boy. I'm here too. Right? Right? We've got you, because guess what? People are still doing that every day too, because the guy who worked his entire life on the line in Dearborn, who said that I am going to Florida when I retire, guess who is not waiting around to find out if interest rates are going to go down in the next 2 or 3 years? That dude, because he just worked 35, 40 years to make that dream a reality. Right? So,
Ain't nobody taking that away from him.
No one. He's not. They are not phased. Trust me. I have the conversations with them. They are not phased. Is this holding people back? Yes. Should it hold people back? Of course. Do not make flippant decisions, poor decisions with your financial future. But at the end of the day, everyone has to have housing. Everyone. You're paying housing costs one way or another, unless you move in with your parents. And trust me, they don't want you there. They say they want you there. They don't want you there.
Right? That's becoming, like, we laugh about it, but it's becoming the reality for a lot of people.
They're building multi-generational homes here in Florida.
They are. It's becoming a thing. I mean, so
absolutely. Well, Eric, we have given the business tonight. That's for sure. What do you want to leave the people with today?
Yeah, I mean, I think if you're in the market, I think it's good to ask good questions. Asking these questions and just being a financial steward for your own benefit, not just accepting what's out there either. All right, there's a lot of headlines that make the real estate market seem a little bit more intimidating than it is right now. Even though interest rates are high, even though prices are continuing to be high, we're still getting clients that are getting concessions on homes. We're getting people into homes with mortgage rates. One of the things I was thinking about earlier when we talked about the interest rates is there was a period of time back in 2020 that mortgage bankers and mortgage officers were running around offering a 2-to-1 or a 3-to-1 buy down. And at the time, I remember just shaking my head at it, saying, "This is bad. This is a bad scenario, because we cannot predict the future. Just like we're talking right now, like we cannot predict the future of what's going to happen. Everybody has to be, really focused on what they can do and what they can control. And here we are into, 1 year later, interest rates are higher. So like, it's great that you got the buy down, but if these rates don't come back down, in 1 to 2 years,
they got great.
There's going to be a lot of people that accepted a mortgage at a lower interest rate, thinking their monthly payment's going to stay low, and it's going to go up. Right? And how those things worked was it's 1% up every single year. So if you got a 5, next year you're going to 6. The year after that, you're going to 7. So they're gonna appreciate. and people are going to be in trouble if they didn't manage those correctly. So, always have a conversation, right? And that's
Yep.
what we're here for. That's why we do these lives. That's why we do, put content out on the channel. This is what we're about. So if you do have questions, consider us a friend, consider us the best resource for you here in the Metro Detroit market. We want to help you make better decisions, when making that move here to Michigan or buying a second home down in Tampa, because we love our boy. We want to get down there.
Yep. Yeah, and that's a great point, right? And so we're happy to help, happy to have the discussion. Again, it's not the right time for everyone. It's a great time for some people. This is all about you, your goals, your financial goals, your home ownership goals. Sometimes those things aren't in balance, right? Sometimes people buy homes for irrational reasons. We get it, but I've been on all sides of this, right? And I don't think that we're going to be out of this anytime soon. I do not think, I just think that this is the foreseeable future. It might take us a decade to get some kind of balance back in the market. It may be less. I don't have, listen, but based upon what I'm seeing, this is the foreseeable future. So you can continue to pay rent or you can buckle down. And we were having this conversation last night and I had one comment that on our live, and they reached out and they said, you know what? I really appreciate you saying the fact that you lived in crappy apartments to make this dream a reality. And we did. Like my wife and I lived in two people's basements. But that was a while ago. This is a journey, but like we had to do what we had to do to get things in order so we could take advantage when the time came. And while I am not thrilled that we have a 7.125 mortgage, I am grateful that I have a roof over my head that my wife and my kids can call their own. And if interest rates ever go down to a point where it makes sense to refinance, I will take advantage of that. But if not, I will just go out and find more money. That is what I will do, because I still have goals and dreams, y'all. And I know you do too. And I'm not going to let the economy dictate to me what our future is going to look like. Now, I can be humbled, and I understand that, and I have been. This is not bravado. It's an attitude, right? And the attitude is I'm going to make it happen. If it's up to me, it will be. If it's not up to me, then that's the Lord's path, and so be it. But that's our attitude. We can make things happen, and you can too, right? So if home ownership is your goal or your dream, or you're in a situation where you have to sell, right, due to death, divorce, or illness, or God forbid, any terrible thing, and you just want to have a conversation, feel free to reach out to us. Be happy to have that conversation. Our goal is not to sell you anything. Our goal is to help make your either dreams or your challenges to a point where you can overcome them and have your dreams too. All right. So with that, we're going to leave you. Have a great evening. Eric, any final words?
I think you nailed it, man. Like we're here for you guys. Like I just want to just really stress that like this, we're heading into some uncharted territories, and now more than ever is just having the conversations about what makes the most sense. So, we have divorce lawyers, we have probate lawyers, we have people, in our network that we lean on. If we're not the expert in that category, we have a team of people. So, just know if you reach out to us, we likely have a solution or a path to lead to a solution. So really just invite that conversation, because now more than ever, I think those conversations that I'm having on a daily basis are more impactful and more helpful than they've been in the past. And I'm really enjoying them. So looking forward to continue having them with you guys.
Absolutely. All right, guys, have a great evening. Take care. We'll see you.